4 stocks. One war that won't end. One AI boom nobody was ready for. Let's get into it. Welcome back to Wealth Signal, where we break down where the smart money is really moving right now. Markets spent weeks pricing in peace with Iran. That bet just fell apart. At the time of this recording, oil prices were climbing back toward the mid-80s as the conflict grinds on longer than almost anyone expected, and the damage isn't limited to a headline number on a chart. Refineries, helium supplies, fertilizer plants, and liquid natural gas terminals across the region have all taken hits. Some analysts estimate as much as 1 to 2% of global oil production could stay offline permanently, even if a ceasefire were signed tomorrow. Even a full ceasefire wouldn't undo the damage already done. Getting anything through the Strait of Hormuz remains difficult, and industry veterans increasingly describe this as a higher-for-longer environment for energy prices, not a temporary spike that fades once the fighting stops. At the same time, the world is scrambling to power an AI build-out nobody sized up correctly. For 30 or 40 years, the economy convinced itself it was a digital services story. An entire generation was told to learn to code, while construction and skilled trades were treated as the fallback, not the future. That bet is unwinding fast. Plumbers, electricians, and construction workers are now pulling in $300,000 to $400,000 a year, while some coders with degrees from top schools are struggling to find their next job. The economy underinvested in physical infrastructure for decades, and now it has to catch up in a hurry. Whenever a society is this unprepared, whoever controls the physical supply gets to set the price. That's why the smartest money right now isn't just chasing AI software plays. It's chasing the hard asset businesses building the actual pipes, plants, and equipment that make the AI boom physically possible. Start with the refiners. Valero and Marathon Petroleum each run roughly 3 million barrels a day of capacity. And here's the key detail. You can permit a new refinery in the United States, but almost nobody has actually built one from scratch in decades. A proposed Texas project, first pitched back in 2016, has struggled just to build a pipeline, let alone a full refinery. That bottleneck matters because these companies are gushing cash flow with nowhere new to put it. Since new refining capacity basically isn't coming, the money has nowhere to go except back to shareholders, through buybacks and dividends. Both stocks are already up around 80% this year, but it's the cash flow story, not a growth story, that keeps this trade alive. Here's the detail most people miss. Gasoline demand has actually dipped slightly since 2019, but diesel demand keeps climbing, largely because of data centers. Estimates put the U.S. data center count somewhere between 3,000 and 5,400, and roughly 95% of them lean on diesel generators as backup power. Diesel fuel goes bad every 6 to 12 months, so data centers have to keep replacing it and running those generators regularly just to keep the fuel usable. That creates a steady baseline of demand that isn't going away, almost like an insurance premium the AI build-out has to keep paying, cycle after cycle. Next is GE Vernova, ticker GEV, a name that keeps hitting fresh 52-week highs, and according to one analyst's read, could keep doing it for the next 6 to 12 months. The company makes the physical gear an AI data center actually needs to turn raw electricity into something usable: gas turbines, transformers, and grid equipment. The numbers behind that thesis are hard to ignore. In the first quarter alone, GE Vernova's electrification segment booked $2.4 billion in equipment orders, which is more than the entire segment booked in all of last year combined. That's not a story built on hope. That's a backlog built on paper. Zoom out further, and the trend holds. The electrical equipment business posted 86% organic order growth year over year. The electrification backlog jumped from $25 billion to over $42 billion, and the company's total backlog climbed from $116 billion to $163 billion in a single quarter. Part of what protects this thesis is scarcity. Only 3 companies, GE, Mitsubishi, and Siemens, control roughly 2/3 of the world's turbine capacity, and building new manufacturing capacity takes years, not months. GE Vernova reports earnings the morning after this video goes up, and history suggests even strong numbers could trigger a short-term pullback, the way TSMC, ASML, and Samsung all sold off recently despite beating expectations. According to one analyst's own return model, GE Vernova isn't built to be a 1,000% moonshot like some higher-risk AI plays. It's positioned more as a steadier compounder, with mid to high teens revenue growth and room for margin expansion, though the stock isn't cheap, sitting around 35 times forward earnings by one estimate. The last name on the list is a lot smaller and a lot less obvious. EcoVyst, ticker ECVT. It's the largest regenerator of sulfuric acid in North America, and sulfuric acid happens to be the most widely produced chemical on Earth, used everywhere from fertilizer to energy to industrial chemicals. Refineries produce spent sulfuric acid, roughly 88 to 89% pure, as a byproduct. EcoVyst owns the entire chain that cleans it back up, including the tanker cars that haul it, purifying it to 98 or 99% before sending it back so refineries can make alkylate, the ingredient that raises octane and lowers sulfur in gasoline. This regeneration side of the business is essentially a cash cow, with EcoVyst holding more than 50% market share in North America. It doesn't need to grow explosively to keep making money. It just needs the refining industry to keep running, and refiners aren't exactly walking away from 3 million barrel a day operations anytime soon. The real growth story sits in the other 45% of the business, virgin sulfuric acid, made from raw sulfur instead of recycled waste. That acid is essential for leaching copper out of lower-grade ore, and as the world needs more copper for the grid and the AI build-out, EcoVyst has been acquiring more of that production capacity across North America. Revenue is on pace to roughly jump from around $700 million last year toward closer to $900 million this year, much of it locked into long-term contracts running 5 to 10 years. The stock has actually pulled back about 9% over the last 3 months, even with year-to-date gains intact, which is part of why some analysts describe this as a name most investors haven't connected to the AI and copper story yet. 4 very different businesses, one common thread: an energy system caught off guard by a war it didn't plan for, and a power demand curve it didn't see coming. Refiners cashing in on scarcity, GE Vernova cashing in on the grid bottleneck, and EcoVyst quietly cashing in on chemistry nobody's talking about yet. If you want to keep tracking how this energy story develops, hit subscribe so you don't miss the next breakdown, and drop a comment with which of these 4 you're watching closest. This content is for educational and informational purposes only. Nothing in this video constitutes financial, investment, legal, or tax advice. Always do your own research and consult a qualified professional before making any investment decisions. Investing involves risk, including the possible loss of principal.